Hi everyone, this is Ed the Finance Guy. Appreciate you tuning in. If you like these videos, please like, subscribe, share, much appreciated. Today's topic, we're gonna speak about, am I getting audited? Now that we're getting close to July 15th, it seems to be the most fearful thing that could happen in your life. Now, the IRS is probably half opened right now. Stimulus checks are going out, tax refunds are all delayed. The question is always, am I gonna get audited? That's the problem. Am I gonna get audited? Now, according to many surveys I've read, 35% of all women and 21% of all men are worried and they dread tax time. They're afraid of getting their documents together, meeting their accountant. It's very, very scary for a lot of people. I don't see why, but again, I'm an accountant, I do returns, I'm used to it. So these people are very nervous. Now, getting audited is the scariest thought in their mind, but it really shouldn't be. IRS audits in 2018 accounted for less than half of 1% of the people that filed returns. Audits dropped substantially as the budget for the IRS seems to get cut every single time a new president comes in. They're constantly cutting the budget. They probably have 25% of the auditors there that were there 3 or 4 years ago. Now, in the 70s, approximately 2.5% of all the people got audited individual returns. Now, in the 70s, tax rates were higher, so maybe it was possible they were making more money, so they audited more people. Now, audits are mostly based on income. The higher your income, the more likely you are to get audited. If you make $50,000 a year, you're gonna get audited at a very small percentage. If you make $500,000 a year, you're gonna get audited at a higher percentage. It makes a lot of sense because the auditor is looking for the higher income people, because if they find you made any kind of a mistake, you're taxed at a higher bracket and they'll make more money. And remember, the auditors are paid and they're trying to collect more than a certain amount of money based on what their salary is. So they're hoping that these auditors collect, let's say, $400 an hour. So if they're auditing you for 5 hours, they're hoping to get $2,000. If you're making $20,000, they're not gonna wanna audit you. They're gonna audit someone making more money so they could make more of a profit off that audit. Now, there are 3 different types of audits. One is a harmless mistake. You accidentally left something off on your W-2 or on your interest statement. You accidentally left off a job that you had coaching a football team, during football season. You didn't put that on your return. So what they do is they will take that W-2, they'll add it to your return, see what you owe, send you a bill with interest and penalty. And remember, when you get a W-2 or you get a 1099 or you get an interest statement, a mortgage statement, a copy goes to the IRS. So even though you didn't file your return yet, the IRS has information on your return that you don't even realize that they already received it. Even before you filed your return, they know exactly what your W-2 would be, what your interest statements would be. They know, they have it all in their computers waiting for you to file a return so they could match it up to see if it matches. So if you put down your W-2 as 110,000, but they got a letter saying it's 120 because you had 2 W-2s, you forgot about one, they know it and they're waiting for your return and they're going to adjust it. So that's a harmless mistake. You didn't do anything on purpose to get in trouble to save money. It's a mistake. The second type of an audit is an understanding of a rule. This year they put on the returns, they want to know if you're reporting any Bitcoin, any cryptocurrency. And there's a way to show the profit, the income, the expense on a cryptocurrency purchase, the purchase price, the sales price. Now there's a big company called Coinbase. Coinbase now sends letters to the IRS showing all sales of cryptocurrency. So they want to know, did you have any cryptocurrency? Or maybe you didn't realize you have to put it on your return, because for years they didn't have any way of knowing what you sold in cryptocurrency until now. So if you forgot to put that sale on your return, it's just a misunderstanding of the rule. You didn't really do anything horrible, but they're going to adjust your return, send you a bill, interest, penalty, and then you'll just pay it and that's it. The third is an intentional error. It's called fraud. Now, you want to stay as far away from fraud as possible. You may be saving some money, but it doesn't pay to go to jail for 2, 3, 4 years because you want to save $5,000. Doesn't make sense. Now, fraud would be listing 4 children when you only have 2 children. You can't say, oh, I made a mistake. Or if, for example, you gave charity of $3,000, but you only have 1,000 receipts, that's not fraud. You made a mistake. You don't have a copy of the receipts. I'm sorry. Redo the return. I'll pay the interest and penalty. But if you say you have a child because you want to get the earned income credit where you would get extra money based on the fact that you're a parent of a child. That is fraud, and that's what they look for, especially with the earned income credit. That's the biggest refund that people get based on that form. So you want to make sure that form is done correctly, and the preparer is also responsible. He signs a form that says he knows that that child really does belong to you. So not only are you going to get yourself in trouble, you're going to get the preparer in trouble. And I know I've read articles about other accountants that listed children that didn't belong to the client, and they ended up losing their license and they got in trouble. So again, you want to stay as far away from fraud as possible. Fraud will result in jail time. They'll audit you for the last 3 years. You just don't want to get involved in that. So now sometimes people also get audited in case they have a business partner and that business partner commits a crime. So sometimes when somebody that's around your circle gets in trouble, that could lead to an audit for you as well. So you have to make sure you're partnered up with the right person, because you don't want to be involved with somebody that commits any kind of fraud, because it's just going to put you in jeopardy. Most audits are conducted through the mail. You're going to get a letter in the mail saying that we looked at your return, and now this is the year 2020. They're looking at returns from 2018, 19. They're going to get a letter in the mail. We looked at your return, and there's a problem with it. We don't have any record of receiving your W-2. So sometimes the employers forget to send a copy to the IRS. The IRS wants to see the copy. You immediately respond to that letter. Don't wait 3 weeks. Don't leave it on your desk unopened. You have to respond to these letters immediately. If you want to avoid a full audit, you respond. You send a copy of whatever they want with a nice letter. Attached, please find the W-2 that you requested. Send it certified mail so that you know they received it, and you have proof that you took care of this problem. Don't let it just linger. Take care of it right away. If you have an accountant, have the accountant send the letter saying exactly what this letter is about. We've responded. Here's the proof. Please remove this liability. If you have any further questions, contact us. You got to treat the IRS very, very nicely, because you don't want a full audit. Full audit is they're going to go line by line and audit every single thing on your return, which you want to try to avoid. Having the mail audits are much better. You just respond by the mail, and then it'll be taken care of. Now, if you're selected for an audit, an actual audit where you have to go to the IRS, it doesn't mean you did anything wrong. It could be something very simple, like wanting to see documents, ask you questions. The questions could be, you're showing $20,000 mortgage interest, but you only earned $25,000 in income. How are you able to pay the mortgage when you're only making $25,000? So now, of course, they're looking for people that are self-employed, that make more money, that are declaring less than they actually make. So these type questions are going to be very common. How are you able to pay $30,000 to charity when you're only making $45,000 a year? Or how can you afford a wife and 2 children when you're only making $40,000 a year? So these are the type of questions when you get audited, you have to be prepared to answer. And they're actually pretty obvious. The accountant should be able to look at your return and say, when he's doing the return, you can't write off $30,000 in charity when you're only making $45,000. There are a lot of people that do things like that. They show more expense than their income is, which is not possible. Most important thing when you get an audit is don't panic. You respond to the notices quickly and completely. Make sure you have all the proof. Look over your return, sit with your accountant, know exactly what proof you need to go to the IRS. If you have a business return, you're going to see you wrote off rent $12,000, get a copy of your lease, a copy of the 12 checks. You have to have everything nicely in a file when you go there. Don't just give all the paperwork in one shot in a box, like your Oscar Madison in The Odd Couple. You want to give everything in files proper, so this way the auditor doesn't have to spend a lot of time reviewing anything. He's always going to find some problem, and they're always going to make you pay something if you go there and you have a full audit. But again, try to get the proof to match exactly what the return said. And if you don't have proof, you gave $5,000 to charity, but you only have $2,000 in proof, you tell the auditor, look, I gave money every week in cash, and I don't have a receipt for it, but I definitely gave that money. The auditor is going to say, you know what, I'm going to allow half of it, and I'm going to make you pay tax on the other half because you don't have the proof. So they're regular people. They're getting employed. They get a salary. They're not looking to get you. They're there to do their job, and their job is to check to make sure the returns are right. It's not like, oh, the guy is out to get me. He's going to make me pay a lot of money. It's not the way it works. He's trying to get your file off of his desk. He's trying to review everything correctly and see if you filed the correct return. And if you didn't, you got to pay the difference. And You know, when you're doing your return, if you put $5,000 in charity, you may only gave $2,000. You know you're committing a little bit of a fraud, but people do it, and it's easy to say at the end that you gave cash, and a lot of times people do give cash. At a church, I know they put money in a basket. There really is no receipt for that. So you put the return down as honestly as you can. If you gave that money, put it down. If you didn't give that money, don't list it as a deduction. It's just it's not the right thing to do. It's bad karma if you lie on your tax returns. Now remember also, if you do get audited and they say you owe $15,000 and you're gonna have a stroke right then and there, remember, if you really do owe the money, you have to pay it. If you feel like you're getting an auditor that's just looking at you a bad way and he's doing things that aren't correct for whatever reason, you request another auditor. I've done that many times where I requested the auditor's boss and I said to the auditor, listen, I don't feel you're giving my client a fair shot here. You're being very critical of everything he's doing. I'd like to go over your head and get another auditor. I'd like to request another auditor. And when I did that, they always calmed down and they looked at everything fairly, and I always got a good audit from saying that. So there are times you get an auditor that's a bad guy, just request another auditor and that's it, and start all over. If you owe money to the IRS, if you owe the $10,000 or $15,000, remember, they're always going to give you an option to pay on installments. So they're not throwing you in jail because you owe the money. They don't want to throw anybody in jail. If you owe the money, you'll pay it over time. They'll give you an installment agreement. If you owe under $25,000, there's no approval. They just automatically approve it. You don't have to go through anything. If it's over $25,000, they want to see your financial statements, how much money you have, where you have money in the bank. So just remember, there are ways out of these things. You make the payments, you make monthly payments, and you pay it off, and that's it. The most important thing to remember is not to commit a fraud. If you owe a lot of money, you can do something called an offer in compromise, which is something we're going to talk about on a later video. Appreciate everyone listening. I hope this helped. People involved in audits, they shouldn't be afraid. Just handle it correctly. Respond right away. This is Ed the Finance Guy. Be safe, be smart, keep tuning in, and see you next time.